Yeah, back again, global economics. And yeah, last time we did some description where we especially saw how within the last 20 years dramatically the regional division of global economics changed, especially if we look at the economy of China. So in the year 2000, the size in GDP of China was roughly about of the Italian economy. So not a small economy, but I think Italy is around number 7 in the world or something like this. And now China is as large as the United States and the European Union. And this, I think, next week I will show you also some other data. Then we have also to admit that they are economically in the same size as European Union and the United States, but they are living 1.3 trillion people, and together in the United States and the European Union, we are somewhere around the half of it. So in population, they are twice as large as United States and the European Union together. So just from the people, there is still potential to even get larger in economic size in China. And yeah, there we then discussed yeah, what changed during this 20 years, and then we identified more or less two phases. One, where the close-up process of China, yeah, was in parallel with opening, with trying to participate in the global economy, and that roughly since the takeover of power of Xi Jinping, it somehow changed, that now they look a little bit more on their own, and especially because of their dependencies on United States and the European Union, but the other way around, they still increase their exports. So maybe they want that we are still dependent on them. And how this will develop in the future, that we will see, that will be neutrally spoken, be very interesting how the global economy is going on. Yeah, well, I will open today a new chapter, and I will start with a short revision, because now we are on the international sphere. And if you remember your macro course, there we discussed some macroeconomic models where we then tried from a theoretical perspective to describe the dependency between economic growth, between government expenditure and savings, later on also on prices, unemployment, and so on. And this was done within the so-called ISLM model. Remember, IS stands for the goods market, where we had the equilibrium condition that in general we find their investments equals savings. But be careful, this does not mean the equation from the circular flow, where we have this ex post view, where we said also in the investments are especially the unplanned investments, and therefore the equality sign here is an identity. Here it is an equilibrium condition, that we assume that in general always investment tends to equalize savings. And from this, we have this name IS curve. And then in parallel, we looked at the money market. And there we classically said, well, we have a money supply and we have a money demand. Money demand, we talk about this also because of liquidity preferences, so demand for money, and therefore the term LM curve. This we will just do in a short revision, and yeah, in the macro course we did only the so-called linear case, and I will do this in a more general way now with you. Then we will look at especially special aspects due to the explanation of monetary policy within the model. And then, of course, we need for the global perspective that we are not alone as an economy, as a country in the world. And therefore, we will also introduce within this model exchange rates and the connection to other countries via the trade balance of exports and imports. Okay, so how did we explain the commodity market? How did we came to the so-called IS curve? Well, for this, we in general looked at the budget restriction of the economy, and there we just said that our income, which we then equal with the production. Remember that this is a demand-driven model where we said, well, we are planning consumption, we are planning investment, and then the production side starts to also produce all our planned consumptions, our planned consumption and our planned investment. And that, so to speak, the supply side follows in this view the demand side. Well, there we made the assumption that in general we assume that consumption is positively dependent on income. So the more richer the economy, the more we are in absolute terms will consume. But also remember that we said on average the part of consumption of the whole economy will fall. So in absolute terms, we are consuming more, but the richer we are, then the part of consumption of total income will fall, and therefore we modeled this as autonomous consumption plus marginal consumption times income. And this term was due to the findings that in general average consumption will fall with increase of Y, and this more or less we can interpret as you do it in the business administration courses when you look at, so to speak, cost function. And the funny thing is that more or less here the letters are quite the same as you have it in the cost function. And if we divide especially this part here, the autonomous consumption, which you then on a theoretical comparison can compare with a fixed cost in a cost function, that this will decrease if we divide this just by y. Yeah, then we modeled the dependence on income on interest rates in the part of the investment. And there we said the higher the interest rate, the lower will be the investment. And the explanation for this we could do in two ways. One was the speculative motive, where we then more or less said, if we look at planned investments, then we are calculating the return, the future return of these investments. So think of you are investing 1 million euros in a new machine or something like this. And then you are expecting that in the first year, maybe you have a return of 500,000 euros, and in the second year, you have a return of 600,000 euros. Will you do this investment? Well, at the first step, you could say it's 1.1 million and it's larger than 1 million, and so it's a good investment. But you have to compare this with the market return, because alternatively you could also invest your money just at some bank in government bonds or whatever, and there you get also a return. And for this you calculate the, so to speak, internal return of your investment, where you just said which interest rate do I need in this investment, 1 million, then 500,000 plus 600,000. What interest rate would equal my future returns of 500,000 in the first year and 600,000 in the second year, so that I just get out my 1 million. So this was, for example, I0 would be minus 1 million. Return I1 in the first year would be 500,000 euros, and the return in I2 would be 600,000 euros. And then we say, well, we could say then the investment at the starting point of 1 million have to equal the net present value of the future returns. And this would be then 0.5 over the interest rate. So the net present value of 500,000 euros. Then I have to divide it by the interest rate factor, because the thought experiment behind this is, how much do I have today to invest with interest rate I, so I obtain in the next year 500,000 euros. And therefore I have to divide it by the interest rate factor. Well, then after 2 years, I have the repay effect, and therefore I have to divide it by 1 plus I squared. Well, and this is just a quadratic equation, and then I get I star, the internal rate of return, and I star we compare with the market interest rate I, and then every investment project with I star is larger than the market interest rates will be done. Well, and then we can say if the market interest rate I is rising, the higher this interest rate is, the less investment projects I will do, and then, of course, in aggregate, investments will fall due to a rise in interest rates in general. And this is a so-called Keynesian investment hypothesis, or, and this I wrote down here, what we can also argue is just in general that uh, the interest rate I, which I find in the market, is just more or less the price of investment. Because if I want to get a credit, then I go to the bank, and right now then they said to me, well, you have to pay 3.5% interest. Well, and the more expensive, so to speak, my credit is due to a higher interest rate, the less investments I will do. So these are the two argumentations because of I have here a minus sign. And then also in general, we have planned government expenditure where we assume no dependence in general or for simplicity on income or interest rate. Yeah, and then we want to deduce from this a dependence between y and I, and these are our so-called endogenous variables. So here we have this equation sign, so there is somehow a dependence between income and interest rate. And now we want to deduce the dependence between these two variables. Well, and for this, we just only need our assumptions about the direction of the dependence of consumption on income and investment on I. Because then we ask how in general changes income, the left side, if I am changing consumption and investment. And mathematically, this is just done by the so-called total differential. So simultaneously, I'm varying all endogenous variables. I can say there is some dependence. If I vary the one variable, then also the other variable has somehow to react. And for this, I have in this equation on the right side the dependence on income in the consumption. So first derivative of consumption with respect to income times how much do I change my income, plus the dependence on interest rates, and this is then the first derivative of investment now with respect on interest rate times the total change of interest rate. Well, and for this, for the consumption, we made the hypothesis that this is positively dependent on income. So this is larger than zero, zero. But, and this I have forgotten here, is also that the marginal rate of consumption is also lower than 1. And what does this mean? This just means that I assume in general that if I get an extra euro to consume, that I will not spend 100% of this euro. So if you get from your grandma at your birthday 100 euros, then we assume that maybe on next Saturday you will spend 90 euros of these 100 euros. And therefore we assume it's positive and the marginal consumption rate is just within the interval of 0 and 1. Well, and this one is negative. And now we can solve, oops, this has to be an I here, sorry. Now we can solve this equation for the relative change of interest, oops, with respect to income. Therefore, we make minus del C del Y times dy. So maybe we should do this also. So then we have dy minus del C dy equals di capital with respect to interest rates di. Then we can take out dy 1 minus dc dy equals di di times di. Well, and then we just divide by dy and we divide by the first derivative of investment with respect to interest rates. And this I have written down here. Well, and then we can say this first derivative is within the interval 0 and 1. So 1 minus some number, we don't know, but we know that this number is between 0 and 1. And therefore, this part has to be positive. And we had assumed that investment is negatively dependent on interest rates. So we divide a positive number by a negative number, and therefore we know that this number has to be negative in general. Well, but what do we have on the left side? On the left side, we have nothing else than the first derivative of interest rate with respect to income. And therefore, we know then that in general, we have a function, interest rate with respect to income, where the interest rate is falling when income is increasing. First derivative, negative for some function, means that this function is monotonically falling. Okay? And then we know that this IS curve is a falling function. It does not have to be a linear function, it is just any falling function. Well, in the macro course, we deduced these just from the graphical interpretation, and this is then, so to speak, the rigorous mathematic derivation of this result. And also we don't need any assumption that we have a linear dependence of consumption on income or a linear dependence of investment on interest rate. We only need these qualitative assumptions of positive and lower than 1, of course, of consumption on income and the negative dependence of investment on interest rates. And then we have this general result, and quite often then we model this in a linear way. Okay, this was the commodity market. Then we come to the money market. And why did I? Okay, because this I wanted to do also in the general way. Well, at the money market, we assumed that we have a positive dependence of money demand on income, and this was from the so-called transaction motive. So the more income we have, the richer the society is, the more transactions we are planning. And for transaction in a developed economy, we need money. And for this, we say the higher the income, the higher is the money we want to have. On the other way around, the dependence of money demand on interest rate shall be again negative. And there we can make a similar interpretation, like the negative dependence on investment, because also we can say that, yeah, holding money is some investment. And holding money just at home means that 1,000 euro today is 1,000 euro tomorrow. So what is this money investment, so to speak? What is the interest of this? It is just an interest of 0. Because 1,000 euro today is also 1,000 euro tomorrow. And this I compare with other investments, maybe government bonds in Germany or in the United States, where I do hope that these countries exist also tomorrow, so that they can repay me if I invest in government bonds. Well, and then these countries promise, if you give me today 1,000 euro, maybe you get an interest rate of 2%. And then I compare these two investments, and then I can argue, well, if I get for an investment in money only 0%, and I get investment for government bonds 1 or 2%, then I will move my money to government bonds the higher the interest rates are of the alternative investment. And this is also just the classical argumentation because of opportunity costs. The higher the interest rate in the market is, the higher are the opportunity cost of holding money. And therefore, I have a negative dependence. Or, also due to Keynesian, there is also a speculative argumentation where we look not only at the alternative of investing in a secure investment like government bonds, but also in the stock market. And there I think you also already know the negative dependence between interest rates of government bonds and stock market prices. So the lower the interest rates for government bonds, the more unattractive is the investment relatively to stock markets. So the guys are moving from the secure investment to the unsecure investment to the stock markets, and therefore the stock market prices will rise. Well, and now we have to think what I'm doing then with my money. Well, if the stock market prices have risen due to low interest rates and I'm looking at my cash, then I just see the ultimate highs in the stock market. And what is then my thinking about it? Well, if due to low interest rates the stock market prices are very high, then in general, the most people, we have to assume, not all, but the most people in the economy will think, well, stock market prices in the future will go down, and then it will be better for me to hold today my money in order that in the future I can invest in lower prices in the stock market. And this then also means the lower the interest rates, the higher is my holding of money. Okay, this would be money demand. Money supply, we model in a very easy way. There we assume that just the central banks supply the money and they can just say the amount of money is that high. And there we had the nominal money supply, and of course this then we have to divide by the price level, which in this model we assume to be fixed, that we then say real money is just given more or less by the central bank, because in this model we assume P fix in the short run. And then we also look at the equilibrium condition at the money market, and this then just means that money supply equals money demand. And here I have the graphical explanation for the increase of the LM curve, but we will do this also in the mathematical derivation. So what we have here is M over P equals money demand depending on income and interest rates, and then also calculate the total differential. And what does this would mean? Well, this is a fixed number. There we say this is exogenously given by the central bank. So there is nothing varying, where we can later on externally vary this, but in general within the model this number is not varying. Well, and if I want to calculate the total variation or the total differential, then this would be 0. Well, here we have the two endogenous variables, income and interest rates. Well, these can now simultaneously change, and therefore we have at first to calculate the change of money demand with respect to income. So this would be then mathematically again the first derivative of money demand with respect to income. So del L del Y, this is the direction, times how much do I change income. So dy. And then plus simultaneously money demand can also change due to interest rate changes. first derivative of money demand with respect to interest rate change times the amount of the change of interest rate. Well, and this we can then also solve for di dy. Well, this can easily be done. Take just this part on the left side, minus on both sides. Then we have minus the first derivative of money demand with respect to income, and then we divide also both sides by the first derivative of liquidity of money demand with respect to I. So divided of del L del I. Well, and then go to the former slide. Positive dependence on income, negative dependence of money demand on interest rate. Then just means that this is a positive number, this is a negative number. Here in front of this we have a minus sign, so minus a positive number is a negative number, divided by a negative number has again to be a positive number. So this is positive, and therefore we then can derive that I of y from the money market is an increasing function in income. Well, and then we put this together and we come to the simultaneous equilibrium of the overall economy. So LM curve means all possible equilibria at the money market, IS curve, all possible equilibria at the commodity market, and therefore the cut of these two functions has to be the point where simultaneously for this interest rate and for this income we have an equilibrium at the money market and the commodity market. Well, and then further on we will now discuss monetary policy within this model. And there in the macro course we in general argued that if we are increasing money supply, that this will induce a shift of the LM curve to the right. This we also deduced from we deduced graphically, and this we will now we will also derive this result in general in a mathematical way. And therefore I need a new slide. Oops. For at first, let us just remember the qualitative derivation afterwards of the result. What happens if we increase money, well, there we argued that this will shift the LM curve to the right. And this means that now, if we take more or less within our head, that income hasn't already changed, but only in a theoretical way. Because then this means that now to the same income as before corresponds now a lower interest rate when we have shifted the LM curve to the right. And then we can think that this has an impact on the commodity market. So increasing money means that interest rates will fall. And now the interest rate feed into the commodity market. There we have the dependence of investment on interest rates. And there we argued the lower the interest rate, the higher is the investment. So from the commodity market, then investments will increase. Well, but then when investments will increase, then also total income is consumption plus investment plus government expenditure. Investments are increasing, then this will also mean that income has to increase. So in a qualitative way, then we can argue that this money supply increase will in the end also push the income in our economy. But this we will also in general mathematically derive. And for this, we just write down our equations of commodity market. There we had y equals c of y plus I of I plus g. And the second money market was small m for real money equals L of y and I. Total differential. So M, this is the assumption now that externally M is changing, that the central bank increases money. This we already had. From this we obtained 1 minus times change in income equals investment first derivative of investment with respect to interest rate time interest rates. And here if we take now the total differential, we assume an external change. Now when we have derived mathematically the LM curve, there we said this one is fixed. It doesn't change. But now we externally changed this. So this then means that on the left side now we have a change because we assume that it changes. So then we have the change of money in general, and the right side will look in the same way as we have done it on the former slide. So dl dy plus dl di di. Well, and what do we have now? This is equation in I and y, and this is equation in I di, sorry, di, dy. These are the things which can change, and dm. And for this, we just can now eliminate one of these two variables. And which one we will eliminate? Just the interest rate, because we are interested in the impact of the change of money on income. So this we will then, that you can better see what we are doing now in another way, that we now write it as 1 and this is 2, that we write this as 1 minus, and this I now call cy, this I call ii, this I call li, and ly, and this I call li, that now we have 1 minus marginal consumptions times change in income minus ii di equals 0. And here we have ly dy plus li di equals change in money. And now hopefully you remember this from your mathematical courses, that this just looks like a linear system with two equations. And now we want to eliminate di. So we multiply the first equation with li and the second equation with large capital. Capital I. If we do this, we end up with 1 minus cy li dy minus li ii di. The right side, 0 times anything is just 0. And here we have ly ii plus li ii di, and now ii times dm. And now you see why I did this. Well, here we have the same parameter in front of the variable of the change of interest rates, and therefore, and here I have the minus and the plus, so I just add up these two equations, and then I end up the first equation I just write down, 1 minus cy Li dy minus Li ii di equals 0. And the second one is now this part plus this part. So 1 minus Cy Li plus Ly ii times dy. This plus this just cancels out, equals ii dm. And now this I can solve for dm over dy. Sorry, dy solve for dy with respect to dm. So this is how much is income y changing if money m is changing by 1 unit. This is the reason why we calculate this. Well, this just means dividing by dm and dividing by this number here. So we obtain dy with respect to dm is ii with respect minus, not minus, 1 minus Ci Li plus Ly ii. Well, this looks quite complicated, and even if you keep in mind that these here are not only numbers, all these are also derivatives, but we have made assumptions about the sign of these derivatives. This was all our argumentation, investments depending negatively on interest rate, consumption positively on income, money demand negative on interest rate, money demand positive on income. Well, and now we sum all these up. This part is positive since marginal rate consumption is in between 0 and 1. This is negative. Money demand is negatively dependent on interest rates. Money demand is positively dependent on income. Investment is negatively dependent on interest rates. So positive times negative is negative. Positive times negative is negative. Here is a plus. A negative number plus a negative number is a negative number. Investment is negatively dependent on interest rates. So smaller than 0. So I have a negative number divided by a negative number. So overall, this has to be a positive number. And this is then the rigorous, strict derivation, what we have graphically done, what we have qualitatively done, that due to our assumptions, an increase of money will increase income in our model. So then an increase of money M will increase income Y. So, and if we go with this result just to economic policy, then yeah, we would just say start to increase money and then we can push our economy and everything is fine. Well, we already argued that this is a short run model and that in the long run, of course, the assumption that prices are fixed will not hold anymore and that the more money we have in the market, that then also prices will start to rise. But we will also look now at the questions. Well, of course, this could be positive, but how large is the effect, even if prices are still fixed? And about this, we will talk in a, in a minute, because if we look back into the last 10 years before Corona, there we had this phase that we really increased money. That central banks started to buy government bond all over the world, and this really increased the money base. But where overall the last 10 years the economy in the world, or even in, or especially in the developed countries, very prosperous, well, we have to say no. Okay, I think this we can skip. Maybe you could look and try this at home. But yeah, now we will go into more detail. Well, what really drives this model? We in general said we make these assumptions about the dependencies, but now we will really talk about how feeds monetary policy in this model. Not only just, well, we are printing money and therefore we are started to buy more goods. And yeah, for this we look on the one side on, so to speak, direct interest rate effects, because yeah, in a modern way we also have to admit that monetary policy is not due to directly printing money, but steering the interest rates. So this effect which we had here, increasing money supply, will lower interest rates. And for this, we look at the interest rate effects in our economy in general. And there we can distinguish between a direct interest rate effect and an indirect interest rate effect, and this can be also divided in the so-called substitution effect and income and wealth effects. So, capital costs, this more or less we have already discussed. If central banks, like in the last month, increase interest rates, what will happen? Well, interest rates are the price of a credit, so refinancing costs will increase, credit interest rates will increase, what we especially see in the housing market in Germany right now. And this will mean that we have a lower loan growth and lower credit volume will be financed. And this, of course, then if we have less credit volume in the market, then especially investment, but also we sometimes finance consumptions via credit, though these two variables, C and I, within our model will fall. This we have already argued, so from this we get the decreasing effect on production. Well, now we can argue this substitution effect. This is also independent to our opportunity costs argument. Now let's think the other way around. Now we assume that we have decreasing interest rates. This means, in general, if the key rates of the central bank will fall, that in a second step, also market interest rates will fall. So the return on the secure investments, especially on bonds, are falling. Then we have argued if the interest rate of secure investments will fall, that the alternative investment, the demand, will rise. And if the demand in the stock market, the alternative investment will rise, then market prices in the stock market will rise. Well, this lowers the dividend of the stock investments. The higher you have to buy the stocks, the lower will your yield in the future. Well, and again, we assume that we have, in general, equilibrium effects, that this process will go on as long as then over time, lowering yield in the stock market will again meet the lower return in the bond market, which was derived from the decrease of key rates of the central banks. So, but now the stock market prices have increased. If the stock market prices have increased, then the owners of stocks have a higher income. You just look at your stock market portfolio and you see, well, the last 6 months, the DAX, I think, has increased from 12,000 to 14,000 points or something like this. Well, then, in your mind is changing something. Although it is not on your cash account at the bank, you just see, well, I have an increase of 5% of my stock market portfolio. And then, if there are many people who see this, well, I'm now richer. Then this means, in general, they think, well, my income has increased. And then still we are in the short run. No direct commodity price adjustment. Then we say again, I'm richer, my income is higher, I will consume more. And in general, also, we assume that investment is positively correlated to income. There you can also then, in general, argue, well, there is an income of companies. And companies have also investments at the stock market. So if they feel richer, then they also start to increase their investments. So again, think of the equation at the commodity market. Total income is consumption plus investment plus government expenditure also. But this is then indirectly because of these substitution from liquidity from the bond market to the stock market. Also increasing production. And income effect, also indirectly. We again assume a decrease in interest rates. If we look at an increase, then you have just to take all the argumentation in the opposite way. This again means credit interest rates will decrease. But this will mean that I change the situation for the creditors and the debtors. If the creditor can now offer its credit only at a lower price, because in general key interest rates has been lowered by central banks, so I can take only a lower price for my creditor. But this means in the income distribution overall in the economy that the debtors will be better off, because I have to repay my credit with a lower interest rate. So there is just a change in the income distribution between debtors and creditors. So they become relatively richer, again, as the argumentation from the stock market, when I look at my stock market investment portfolio. Now the people who have a credit think they are a little bit richer. Maybe again you can think of a private housing market investment. There we have a law that after 10 years you are allowed to refinance your house. No matter if your contract lasts for 15 or 20 years. You can just say, well, my credit line is, let's say, left 55,000 euros. Then you can just say, I will do now a new, I will have now a new credit contract with then maybe, due to this decrease of interest rates, with a lower interest rate. So then I feel richer, because then I recalculate my repayment for the future. So they will, again, increase their demand. Positive dependence of consumption of income. Well, but the creditors, they are worse off. And then I look in general at the number of creditors and debtors within an economy. And there I would say that the relatively poor people will be, with a higher probability, the people who need a credit. So in general, we assume that there are more people which have a credit compared to people who give credit. Because if I'm rich, then maybe I think, well, today I don't need 100,000 euros, so I give this amount out by a private credit. So therefore, in our economy, we think that there are more people which increase their demand than there are people which decrease their demand because they have less now. So in the aggregate view, then we can assume that due to the effect that more people increase their demand relative to the people who decrease their demand, that there will be an increase overall. So that the additional demand of the poor people will outperform the decrease of the demand of the rich people. And then again, we will have an increase in production. And the last one is the wealth effect. And this will mean, or here the argumentation, again, a decrease of interest rates. Then means, and right now we have the opposite argumentation, because of the increase of interest rates, then there is a possibility that people and small companies and so on cannot repay their credits. And if we have a decrease, then it's easier for them to repay their credits. And this will mean, with a decrease of interest rates, the risk of illiquidity, that I cannot repay my credits, will fall. Well, if in my expectation I think I can meet my expenditures in the future, then I can also think of that I will do right now, because of this general situation of low interest rates, I will start to invest, or I will start longer investments. So especially the consumption of longer term goods, of so-called durable goods, will increase. Well, and what part are especially durable goods? Well, there we are again in the construction sector. And this means that especially the demand in the real estate sector will increase, or the other way around, like we have it right now. The demand in the real estate sector will decrease. And remember, in Germany, we have a part of the construction sector of about 5% of GDP in Germany. In other countries like Spain or Great Britain, there the part is 10 or 15, even 15%. So an increase of this sector will definitely have a relevant impact on total production, on GDP overall. And this then will also increase production. Okay, again, now I hope that you have a deeper understanding how what different channels are behind this, and that you now have not only the view that, well, I'm printing money and I'm start to buy more goods. Question? Okay, key interest rate is just the interest rate for which the banking sector can take central bank money. And we have the law that within the banking sector, they have to have central bank money. So if the key interest rate, right now, I think it's 4.25% of the ECB, then they have to pay, if they want to have the central bank money, an interest to the ECB of 4.25%. Well, but these are of course costs for the banking sector. And then if this interest, which I have to pay by law, because I need this central bank money, then I recalculate. If this is increasing, then I start to recalculate my own cost position. Then I have higher costs, and the impact is then the banking sector gives out the credit. They also start to increase their interest rates. And so, well, this of course doesn't happen instantaneously, but there, for this we have the argumentation that if the key interest rate of the central banks are changing, that this over time feeds into the free market for credits. Remember, in the macro course, we talked a lot about the yield curve. So, in general, change in key interest rates of the central bank will over time feed into the capital market. Since an example, increase of key interest rates will increase the costs for the banking sector in general. Well, but then there is also the assumption that we have a more or less a direct effect of changing key interest rates of central banks on the short run interest rates in the market. And then over time, we will see that also the longer term interest rates will also change in the same direction as the change of the key interest rates. Okay, so or then compare with the argumentation with the yield curve. Yep. What do you mean by substantial? Ah, so, decreases substantially. Oh, this means, well, 0.25% change of interest rates will not have this large effect, especially, oh, now, sorry, then I misunderstood you. So here we are in the argumentation of wealth effect, so long time effects. Well, let's assume as a thought experiment, you have an interest rate, a key interest rate of central banks of 3%, quite usual times. Maybe nothing really happens, and now the central bank increases from 3% to 3.25%. Then, of course, there will, due to the other effects, then there will something happen at the stock market and so on. But there will not be a large effect then in the end in the real estate sector or in the construction sector overall. Because this is not a real difference if I have to pay a 3 or 3.5% for my long-term investments. There, this I meant by substantially. So, and this, there is maybe some special experiment we made the last year where we very, very drastically increased interest rates just within 6-9 months from 0 to 4%. So 400 basis points. And if you talk maybe in your family or something there, when your uncle, cousin, or somewhere else thought about in 2020 maybe about, well, I want to start, I want to build a private home. This is my dream. And then they did their calculations, and half a year later, they had to recalculate their financing program. And now, not with a housing credit of 0.5%, but with a housing credit of 3 or 4%. Then they said, whoa, shit, where are my additional 50,000 euro I need? And this I meant by substantially. Okay? Oh, now I have talked very long today because we ran out of time. Because now the interesting part should start. But I think it was also quite good to take here a longer revision and yeah, a deeper understanding what this model is about. Because now we want, after we have qualitatively argued that we have, oh sorry, where we are here. Here, that we have here just, well, we have a positive impact. Now we want to argue, well, what are the circumstances? How positive is this effect? And about this, we will talk on Thursday. I have a meeting, and well, the appointment will, or it is announced that it ends at 12 o'clock, but I don't know if we are really ready. So maybe I'm a little bit late. If it takes really longer, then I will make an announcement in Moodle. But yeah, hopefully I just can start the lecture on Thursday in time. Okay, thank you very much for today.